Hey guys, this is the first video of this class, so welcome once again. And this right here is the PDF that you have access to. It may be a little bit different because I do update as we go, but regardless, you are going to have access to the most up-to-date PDF. So you do have this PDF. If you want to print this out, if you want to pause me, print it out, follow along with me, take notes, feel free to do so. If you just want to open it up in your computer, take notes on your notebook, I recommend y'all take notes, but this is where we're going to start. So again, this is set up to where if you're already an agent, what are we going to do from the basics? We're going to meet with the client. We get that application. It goes through underwriting. This is a huge chunk of the test. So I do need y'all to be blanking out, y'all, to be aware of this process and really understand it. All right, so let's get started. So the first thing to know, what is insurance? The basic definition of insurance at its most basic point. It's going to be the transfer of financial responsibility. And you're going to see I'm going to point things out, I'm going to highlight things, and I'm going to point out the most important things for y'all to know. So what are we doing when we are buying an insurance policy or selling an insurance policy? We are helping that customer transfer the financial responsibility of when a loss happens to the company. So we're saying, you know what? I don't want this. I don't want to pay that big bill when I pass away, or I can't pay that big bill when I pass away, right? So you pay it. I'm going into this contract, this life insurance contract. I'm going to pay my premium consideration. I'm going to pay that consideration the way I agreed to, monthly, yearly, whatever. And then they're going to end up paying whenever it's their turn to pay. Okay, guys, so quick note. Anytime you see the word consideration, this is automatically what I want you to do. You're holding a coin. It's the letter C. This is consideration. Consideration equals money. We exchange money. We exchange value. All right. So I, the customer, I'm going to pay my consideration. I'm paying my premium every month. If I said it's a yearly premium, I'm paying that premium. The company, their consideration, their exchange of value is they're promising to pay money to whoever they're going to pay it when it's their turn to pay. So health insurance policy, they're paying it to the doctor. That's their consideration. Death benefit to my beneficiary. It's not to me, right? If it's a cash value payment, that's coming to me. If it's an annuity payment, that's coming to me. But again, consideration, I'm paying the premium the way I said I would. They are going to pay when it's their turn to pay, whatever that may apply to, right? So if in life insurance, they pay when the customer passes away. That's their consideration. Their promise to show up, to be there, to pay. I have taken that financial responsibility off of my hands, given it to the company, and that's all that insurance is. Let's talk about car insurance. Car insurance. If I'm in a car crash, I don't want to be responsible for the bill to fix my car or to fix somebody else's car, and God forbid that we're hurt. I don't want to be responsible for that hospital bill. So I'm transferring that responsibility of paying all of that to my insurance company. That is literally all insurance is. And when that car crash happens, they're going to show up, they're going to pay, right? Same concept, same idea. So at its basic form, and that applies to any and every type of insurance, we are getting rid of that financial responsibility, giving it to somebody else, giving it to the company we're making that deal with in this case. So very important to know your definition of insurance and what it is. And one vocabulary word that I need y'all to keep in mind is the word risk. A risk is the potential for a loss to happen or the eventual loss that is going to happen. Both basically exist in every given situation. When it comes to our life and life insurance, there's always the potential that the customer is going to pass away. So there's your risk. It is the risk of that loss potentially happening at any given moment. The loss that is going to eventually happen is that the customer will die. We're all going to die, unfortunately, you know? So there's always that risk. That risk is there. So we can insure our lives. If the risk is present, if there is a risk to insure, then we can insure that item. So on your PDFs, go ahead and pause me and work on that activity right there. So insurance. Again, basic definition, transferring the financial responsibility. If you had to describe insurance or explain it to a 10-year-old, how would you say it? I want you to write that down there in your own words. And I also want you to fill in the little box right there. What are different things that we can insure? First, life, of course, that's what most of us are here for, to get our life insurance license, because we can insure someone's life. We can insure someone's income or retirement. This is why we have 401ks and annuities and different types of savings accounts, because eventually the risk is there that the customer could always lose their job, could always lose their source of income, and that potential is always there, right? But eventually they will retire. So they are going to eventually lose it. So we can ensure that in the form of annuities, 401ks, IRAs, all of these things, right? So I bet y'all haven't thought about that, but those savings accounts are insuring your income. They're insuring your retirement. Vehicles, like I just explained a minute ago, there's always that potential for an accident to happen. There's always that eventual loss as well. Let's say that somebody's able to, and I'm so jealous if they can, or if anybody out here has, because it hasn't happened for me. But what if you're able to hold on to your car for 15 years? You do your maintenance, you do everything you need to do, and you're good with it. My goal's been 10. I haven't been able to get there. It's a struggle, but it'll eventually happen. But anyways, y'all, vehicles, right? I've been in, wait for it, my PNC people are about to lose their heads right now. I've been in 11 crashes in 7 years. These people, my vehicles, there's a potential for a crash to happen. Sometimes it's a total loss, sometimes it's not, right? But it can happen. There's always that potential for an accident. Oh, by the way, they were not all my fault. I have proof if y'all need that. But anyways, there's that. But then there's always that eventual loss. Let's say that somebody is awesome with their vehicle, unlike me, and they're able to hold on to it for 10 years or 15 years. Eventually, due to wear and tear, even if you go get your maintenance, go get your oil, go get everything fixed and changed, you're going to have to get a new vehicle due to wear and tear, or laws that might update, or safety features and things like that, right? So eventually, there's going to be that loss. So we can insure cars. What are 3 other things that you can think of that we can insure and that we do insure, because there is that potential for the loss to happen or that eventual loss that can happen? So pause me, go ahead and work on that right now if you'd like, and just think about it. And also, back to our definition of risk, which we're going to cover more and talk about more in a little bit, we are insuring the risk of that loss happening. We're insuring the risk of that life being lost. We're insuring the risk of that car crash happening. So when we are going through underwriting and our applicant is being investigated by our underwriter and all of that, that right there, he is being referred to, or she is being referred to, as a risk. Do we think this is a good risk for our company? Do we think this is not a good risk for our company? All right. So just keep that in mind as well. So go ahead and pause me and go ahead and complete this activity. All right, so here we are, guys. Risk, the potential for the loss to occur. Also, that eventual loss that will occur. So this is another definition I want you to think about. There are 2 types of risks that always come up on the insurance exam. So I want you to think about these and to learn these. The more important one is the one on this side. So right here, guys, I want to point out real quick on my PDF, you're going to see speculative risk, literally just in black right here. And then here you're going to see pure risk on one side and insurable risk on the other side in red. So sometimes the insurance exam likes to use interchangeable terms. So they like to use the synonyms for the same things. Pure risk and insurable risk are the same things. So you'll see AKA, or you'll see a dash, but you'll see one in black and one in red. If there's more than one term for a certain thing, you're going to see them listed out, and you'll see them in different shades of red, or you'll see red, black, whatever I had to do. So just keep in mind, and that's why I did that, okay? So that'll be throughout your whole PDF. Excuse me, all. So Speculative risk. We don't like this type of risk in the insurance industry. We don't make money off of this risk. There is a chance of a positive outcome, and we don't like that. We like it when the odds are totally in our favor when we're going to make a bet. A insurance policy is a legal bet. Okay, so speculative risk, gambling, for example, we do not insure gambling because there's that chance that you could buy that one ticket, make you a millionaire. Too good of a risk. Let's think about the scratch off tickets, though. Scratch off tickets, the chance that you will break even or actually make money off of this is a 3 out of 5. That is too good of a chance of something good happening. We do not insure gambling. While the scratch offs and I mean the tickets like Powerball, Mega Million, and all that are much crazier, harder odds, it's also not impossible because people win money on those tickets all the time as well. But let's just focus on scratch off tickets. The odds are that 3 out of 5, you will either break even, so you don't lose, or you actually make money. And just think about it. If you buy a $1 scratch ticket and you make $1, we're not making a big deal about it, but we didn't lose money. The insurance company doesn't like that. If we buy a $1 ticket and we make $2 off of that, we just made 100% profit if we're looking at numbers only, right? Insurance company can't win with that. Or if you buy a $1 ticket and you get $5 off of that, 10, 100, whatever, then awesome. We just made a whole lot of profit, right? So we are good with those scratch off tickets. So the idea is if you go and buy 5 of the same roll, 3 out of 5, you'll either break even or you'll make money. Now, that hasn't necessarily been my case, but that is the statistic out there. So speculative risk. Gambling is a speculative risk. We can speculate that there's going to be a good chance of a good outcome. We don't like that in the insurance industry. We do not insure speculative risks. All right. Another thing I want y'all to know is everything is super straightforward. You don't have to overthink these things, guys. For the most part, all of the generic names for our policies, our writers, and all of that is very straightforward and to the point. So if you pay attention with me and if you follow along with me, you're going to see how I explain it. And I want you to find ways to explain it like this for yourself as well. All right. So speculative risks, we can speculate it's going to be positive. Think about it. I don't know. But just keep that in mind too. Everything is straightforward to the point. We don't have to overthink it a lot. The next one, pure risk, aka insurable risk. And again, black and red right there because that is the same thing. So question 4 could say pure risk. Question 29 could say insurable risk, and the rest of the answers or the questions or wherever it comes up could say pure risk. And they will interchange them because they want us to get tricked, right? But if y'all pay attention, follow along with me, make your notes, and pay attention to the way that I've put it up and set it up on the PDFs, you will be able to catch those and you'll be able to understand the different synonyms they use for these things. So a pure risk is a risk where there is a very small chance of a positive outcome or a 0% chance for a positive outcome. This is the ones we like. All right. Insurance companies, we like the doom and gloom. We like it when it's not possible for the customer to end up with the good, happy outcome. We are over here in the darkness and we are in this mind frame of the darker, the more negative, the better, because that's where we make money, right? So my examples here, injury, death, health, all of those things, there is that risk factor, right? The risk, the potential for that loss to occur at any time. So a few years ago, I was teaching, I was walking up a concrete set of stairs going into class. I fell, y'all. I couldn't have aimed better for that staircase had I actually jumped towards it. So anyways, my knee literally hit where the stairs do this, and it's a concrete staircase. So my knee literally just hit like the edge of the stairs. Everything fell. My Monster drink went one way, my stuff went the other way. Anyways, I got up. I was hurt. I couldn't move my knee correctly. I go to the doctor eventually. Finally, The doctor's like, your knee got dislocated. And eventually you're going to have to get operated. Now, thankfully, I'm fine now and all of that. But that is what the doctor said initially. And I did go to therapy. I did do all that. But my knee health probably will not be the best for the rest of my life. And eventually, they already said you're going to need to go get operated. So chance for positive outcome, 0, right? Less and less and less, especially as we age, injuries, things like that affect us in negative ways. That's not going to get better, right? So insurance companies can go ahead and give us an accident policy, right? Health, the same thing. There's always that potential. You go to the doctor for a checkup and the doctor says, I'm sorry, patient, you have X, Y, or Z. And now you need medicine, you need therapy, you need this or that. And once somebody gets some kind of a treatment or some kind of a diagnosis like that, right, it's going to start going downhill, sadly. And then as we age, even if people don't get those kinds of diagnoses or issues or whatnot, little by little, it starts deteriorating. So we can go ahead and ensure our health. Death, like we've talked about, everyone's going to die, 0% chance of a positive outcome, right? So again, doom and gloom, 0% chance of a positive outcome. This is our insurable risks. These are the risks we will take a chance on because the odds are stacked towards the insurance company. This is where we're going to make our money. Okay, guys, I'm sorry. I've been kind of sick lately, allergies, all of that. So hopefully that will not bug us as much. But pure risk and insurable risk are the same thing. These are the ones we like. And the next thing for us to look at are our hazards, y'all. So hazards, there are 3 types of hazards. What is the hazard? Danger, right? Think of hazard lights and things like that. So hazards, a hazard is a condition that makes the chances of a loss occurring happen sooner, okay? It increases the chances of that loss occurring. So the first thing, a physical hazard, a moral hazard, and a morale hazard. These 3 types of hazards are labels that your customer is going to get once we are interviewing them and reviewing them and things like that. So first one is going to be our physical hazard. This one is mostly tied to somebody's job. This one is a hazard that has to do with someone's surroundings, okay? So if somebody works, let's say a construction worker versus a librarian, the construction worker's environment automatically than the librarian's environment. There's going to be they're going to have to wear like hazmat outfits or maybe not hazmats. I'm thinking like the helmets. They're going to be in more dangerous situations. There's power tools. There may be roofs coming up, things like that, that make it more dangerous for accidents to happen, for injuries to happen, and all of that type of stuff. So my construction worker and my librarian are going to be labeled a little bit differently by the underwriter. This person, most of the time, is in a dangerous environment, and this person is not. This person is labeled a physical hazard, and his premium is going to get raised. Or depending on what type of a construction worker he is, or what type of a dangerous job this person has, they can automatically get denied. For example, pilots, stewardesses, flight instructors, anybody who is in an airplane while it's in the air or who has an active pilot's license, automatically getting denied. Why? Because they are labeled as a physical hazard. These individuals who work on airplanes are going to have to sign what they call the aviation waiver, which is going to exclude dying in an airplane crash while they're on the job from payment of the benefit, okay? Sorry, y'all, and we're going to talk more about that later, but just know physical hazards could possibly get somebody denied coverage just completely. So let's say my construction worker, though, they're in the construction zone. It's not going to be a denial. It's just going to be a raise, a bump up in premium. But this has to do, again, with their surroundings. We're also going to look at the environments that people live in. So let's say myself, I'm in San Antonio, Texas. Typically, it does not rain here. We don't get hurricanes. We don't get crazy storms. Most of the time, it is about 120 degrees out here. Okay, maybe it's like 100, not 120, but it feels like it is. So anyways, point is we don't get crazy storms. Somebody who lives in Houston, though, they're real close to Galveston, or let's just say somebody who lives in Galveston, they're right on the beach, all of that specific times of the year. There is hurricanes, there's storms, there's floods, all of that, right? So they're going to look at those locations too. This customer lives here. This customer lives by the beach. Well, this customer is probably has a higher chance of drowning because they're probably going to the beach. This customer has a higher chance of getting attacked by some kind of a shark or sea animal, and or drowning in a flood, or getting stuck in a flood, or crashing due to bad weather, right? Or being in that bad weather situation, having to drive through bad weather versus this person. So now it's not going to completely make this person a bad candidate, a bad risk for the insurance company, but this person who lives in Galveston, who has all these possible dangerous situations they could potentially end up in, and there's a higher chance this person will end up in that situation versus the person who lives in San Antonio and in the 110-degree weather. That's probably more accurate, y'all. This person's going to pay like $15 a month more than I, right? Just because of where we live, our physical surroundings, our home environment, right? Puts us in those different types of situations. So that is one. Physical hazards, our surroundings are going to determine whether we may get denied or approved, and that's determined on our job or our price point for premiums, right? Because that's what they're trying to do in underwriting. Underwriting is trying to figure out how soon will this person die? And it sounds ugly to say it like that, but it is true because that's what they're trying to get. They're trying to get the most amount of money from us as they can in the long run, right? And they don't want us to die anytime soon because, of course, they want us to pay our premiums. But if customer A looks like they could potentially live to be 80, and let's say they're both 40, awesome. We can charge customer A $100 a month. But if customer B, who's also 40, has health issues, lives by the beach, and might have a more dangerous job, there's a possibility he could die at 60. So we're going to charge this person $300 a month because now we've got a customer for 40 years versus about 20 years, right? So that customer with the shorter lifespan projection is going to get charged more. And that is what underwriting is when we're looking down and at the bare bones, guys. We're trying to figure out, do we want to take this risk on, and how much are we going to charge this person? And how are we doing that? We're trying to figure out how many hazards are they? Are they labeled all three? Are they labeled one? How possible is it for them to be in that dangerous scenario or situation? How is their health, right? We're looking at all these elements and trying to figure that out and trying to stack the odds in our favor that we're going to get money. So that's what we're doing when we're doing underwriting. The next one, moral hazard. This has to do with the person's character and reputation. So if you get a customer and they tell you, for example, oh, I've been working here for 10 months. Let's say it's Target. And we're like, awesome. We put it in the application and they tell us a little bit about their background. We put all that in the application. And then our underwriter, because they can do this, decides to call their employment and verify employment. And that boss says, oh, yeah, he's been working here for 4 months. Now antennas go up and we're like, wait, why did they say 10 months? What happened? Why are they lying? Now this person's character and reputation comes into question, and then the underwriter can go in and look at all of their background. What is their true employment history? What is their medical situation? And we're going to look at the MIB report. That would be your Medical Information Bureau report. We can look at their consumer report. We can look at anything and everything you can imagine to try to make the best decision for the company about that customer. All right. So moral hazard, if they're willing to lie, and the train of thought is if they're willing to lie about how long they've been working here, we're going to be thinking, well, why are they lying about their work history? We're going to look into it. We're going to see what is the shadiness going on here. Have they ever had some kind of a fraudulent claim? Because if they're willing to lie about their employment history, what else are they willing to lie about? They're willing to lie on an official application. What else is going on, right? Sorry, y'all. So that would be one. One, let's say we get labeled that, not necessarily a cause for canceling or denying this customer. We're definitely going to keep an eye on them. We're going to be more thorough with our investigations. We're going to keep looking at them, possibly raise that premium on this individual. So that is one possible label they can get. The next one, the morale hazard, the morale with an E, morale versus moral. Morale is the person that does not care. This guy's like, YOLO, who cares if it's raining really bad right now? Everybody's going 40 miles an hour. I'm just going to speed on through, go 80, 90 miles an hour. I'm going to get there faster. I'm going to get home. Forget all these other people. They don't care that what they're doing could put them in a dangerous situation, could hurt them, hurt other people. If I'm driving down the highway like 90 miles an hour and it's real bad weather, maybe I should go ahead and go over to the side and not drive. But this person, your morale hazard, is the person who doesn't care. They're like, whatever, we're going to go there. We're going to get there home. We're going to get home faster. Everybody else is moving out of the way anyways. There's nobody driving right now. Or again, they just don't care. So they would be willing to put themselves in those hazardous situations. Pilots, stewardesses, anybody who works on an airplane is going to be labeled not only a physical hazard, like I talked about a minute ago, but also a morale hazard. Anybody who has a dangerous occupation, cowboys, rodeo participants and riders, scuba diving instructors, anybody who works on a boat, you are willing to put yourself outside of our element. For us humans, our element is earth. If you're willing to go out on a boat, you're in the ocean, you're not in our element. If you're willing to get on an airplane for more hours out of the day than you are on the land, then you are out of your element. You are putting yourself in a dangerous situation and you don't care. So therefore, the insurance companies could potentially deny these people, and they do, right? People who work as stunt doubles. So I worked with the customer some time ago. He was a stunt double and he did it just every now and then type of a thing. But he had the hardest time finding a company to cover him because of his side gig or whatever, being able or being willing to go into a car that's going to go 1,000 miles an hour and then eventually get blown up or whatever. All of those things are taken into effect. And if somebody, the more of these points that somebody is labeled, the more likely they are to get denied. So think of your hazards as that. Everything they're willing to do, everything that they are labeled as is making the insurance company feel like, hey, you know what? This risk is too risky. This risk is too dangerous. We do not want to insure this person. Or if we do have to or want to insure this person, their premium is going to go skyrocket. So keep that in mind. Hazards, we're trying to figure out, is this risk, this customer, potential customer, is this applicant a good applicant for us? Are they willing to lie on the claims? Is that in their background? Do they have any situations that seem kind of shady in their background? If they do, they're a moral hazard. They've been willing to do this shady action or that shady action. What else are they willing to do? If they're willing to go, like I said, jump out of a car, get on an airplane, get on a boat, and that's where they work, or that's where any of this type of things could happen, right? You're not in your element. They're a moral hazard. Do they work in a dangerous environment? Physical hazard. The more of these labels somebody gets, either they're going to get denied or again, their premium is going to get increased. So that is our hazards. All right, now we're going to talk about the distribution systems, y'all. So our distribution systems, these, like the name says, is how a company chooses to distribute their products to the public. So how do they sell their products to the public? Pretty much every company at this point uses an agent. An agent, and here's two terms for you to know, two bits of vocabulary. An agent is a person who is independently licensed through the state. Right now, you are working to get your life insurance license, and you are going to be an agent. Once the state gives you your specific license, you're going to be good to go. Then you go and you sign up with the given company, whoever you choose to work with, and you get your writing numbers and all of that. You'll become an authorized agent, which we'll talk about in a minute. But you've got your license, you're deciding to work with one given company, you will be an agent of that company. Only one company, right? Ooh, I wish this would highlight a little bit better, but it is what it is, y'all. So when you're an agent, you work with one company. If you want to become a broker, that means you work with more than one company. All right. So that is the difference between an agent and a broker. Somebody asked me this a while back, and that is basically what it is, guys. So if you hear companies say we work with brokers, we work with agents, those terms are interchangeable. It's a broker is an agent. Again, the only difference, they can sell for two companies or more than that. An agent typically only sells for the one company. And this is how the companies have their systems set up. So for your exam, I really want you to pay attention to System 2 and System 3. Those are the ones that tend to come up on the test the most. These are the most common ones, and most companies participate in System 2 and System 3. Not as many participate in number 1 or number 4 anymore. All right. So let's talk about the different types of systems, guys. The first one is your career agency system. Career agency system, this is the more traditional one. Once upon a time, they were all like this. You worked for the one company and that was it. You're committed and you're going to set up and you're going to stay with that one company. Over the years, things have changed. Agents like the ability to work for more than one company. We want some freedom. We want some more well, I guess, yeah, freedom, less restrictive, less rules, things like that. Really, guys, when it comes to the insurance industry, the agents have the power because the companies rely on us to sell their products, to distribute their products, right? So every distribution system is set up with us as the main, what would be the word? As the main way of selling, I guess. But let's talk about the systems, guys. So first, career agency system. So your career agency system, in this system, there are established offices. That is the main thing. Customers go to you in your office. You are expected to work for your company in your company's office, at the very least on paper. Now, real life, things have changed. COVID has made things way different now, but on paper for your test, this is what I want you to know. All right. There's established offices. Companies expect you to be in the office, to have a set schedule. You're going to work from 8 to 5 p.m. You're going to be there. Your customers are going to come to you. You do not travel to your customers. You don't go to their house. You don't go to anywhere else. They always come to you. Also, system number 1, customers are customers of the company, not the agent. You do not own your book of business. Those clients belong to your company. If you leave the company, if you quit, they stay with them. That is the captive agent. That is the traditional system, your career agency system. Here you are an agent and you are only able to and allowed to sell for that one given company. You're not allowed to sell for anybody else, and typically there are stipulations on your contracts and whatnot saying that you cannot work for any other company in any capacity in the insurance industry. Now, do not compete agreements have been phased out. However, companies will try little things here and there to try to trick you and to try to get you to agree that you will not work with different companies. However, this is the more traditional system. And again, real world versus test world are different. I want you to think of test world as the Barbie world type of thing, a utopia. Everything is perfect, things don't go wrong, all of that. So for those of you who saw the Barbie movie, I want you to kind of have that in mind before she starts thinking about all of the craziness or whatever. But think of that utopia. Everything's perfect, things don't go wrong. Customers are never going to be late for a meeting. They're always going to come see you. They're never going to like run out on you. They're never going to stand you up. None of that, right? So you are always going to be on work on time. There's never going to be traffic. You're going to get there from 8 to 5. Things are going to be perfect and amazing. And that is going to be test world. In this instance, and for any questions you have on your exam, you always want to do the most type of thing, especially when you get scenario questions on your test that says, what would you do if you missed one question on the application? You don't call the customer, you don't get on Zoom with them, you go to their house, even if they live 5 hours away, you answer the one question in person, then you go back, send it back, even though it's going to be one question, y'all, all day long I'm on the phone, I'm going to call the customer and be like, hey, guess what? They have one more question for us. They're so annoying. Anyways, blah, 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 right? But that would be the real world. Test world, we have to do everything by the book. And that means everything is going to go perfect, right? So that is what I want y'all to keep in mind as well when you're reading the scenario-based questions on your exam. Okay, so these individuals are agents who sell for their specific company. Again, you are an agent. You sell for one company, that's it. No other companies can you sell for. You are also a 1099 independent contractor. So with the traditional companies and this setup, you're going to be still a independent contractor, which means you are going to be commission based. Even though the company will set hours for you, will expect you to be in the office from 8 to 5 or whatever schedule, and you will have like a manager type structure. Now, again, this is by the book what the exam expects. Okay, so that right there is more restrictive, and that is the traditional form. The majority of companies have moved away from that, although there are still a few bit of companies that are clinging onto that way of life. All right, so this is our career agency system. The next one I really want you to pay attention to. This is where most agents start. They have more freedom and more room to grow, and also more companies that they can represent. So here with your personal producing general agency system, I want you to think of that MLM structure. Now, I'm not bashing MLM. I think MLM is good, but that pyramid type of a structure, you sign up with them, they have a contract with all of these different carriers, and then you are able to recruit individuals, train individuals, grow your offices, things like that, and kind of break up and make your own insurance agency through that parent company you signed up with. Okay, so personal producing general agency system, you're going to have your parent company. This is your IMO. And with this company, typically that parent company has 20 companies that they have contracts with, 50 companies. These are those agents that are like, I represent 90 companies, which is crazy to me. But I've heard somebody literally say that. I just looked at him like, please don't go say that when y'all are already licensed and working, guys. It just sounds like it's not nice. It's over the top, whatever. I don't even know what it is. I just don't think it's good. Anyways, you have your parent company, and with that parent company, they already have their contracts with their carriers. The carriers are Mutual of Omaha, National Life Group, F&G, the actual insurance company and providers. Through their contracts, you can sign up with one and be an agent, or you can sign up with 2 or all 20 or all 90 and be a broker. So you have the option to choose how many and which companies you actually want to sell for. All right, so a little bit more freedom. You're also a 1099 independent contractor, so you are going to be commission based. This is typically the way that it works, and you are required to have your license with your state. So again, agents, basis, you have your license with your state. You're able to sign up with one company. And this is what that illustration looks like, guys. You are the agent, you go to the insurance broker. This is going to be the companies like FFL, Primerica, WFG, and the other companies that are similar. That company, your parent company, has contracts with Mutual of Omaha, F&G, Transamerica, and then you can decide, you know what, I only want to work with company number 1, or I want to work with company number 1 and 2, or 1 and 3, or however many companies you would like to sign up with. All right, here you typically have a manager, you have that insurance brokerage, that parent company. If you need help, you need support, you need training, they are going to be there for you. They're going to help you. And then you also have your carriers that you can call for support and help as well. All right, so this system, you get a lot of training, you get a lot of support. And again, this is your MLM type of company where you will be able to go recruit other agents, train them and help them get licensed through this system as well. Right, so that is your first one that I really want you to know, because this is where typically most agents start. The majority of companies participate in this system, your personal producing general agency system. The next one is your independent agency system, AKA, and again, guys, anytime you see this right here, one in black, one in red, this is going to be the synonym for it, the other name for this program or for this specific system, right? American agency system. This is the true independent agent, okay? This agent is independent. And I want you to think of the 4th of July, fireworks, all of that, because this is your American agency system and we're independent, right? So your independent agency system, your agent is going to cut out that middleman. We're cutting out this company right here. We have no insurance brokerage. We go to the state, we get our license like y'all are doing right now. And instead of going through one of these companies, you are just going to call your carriers directly and sign a contract specifically with those carriers. So this agent decided, I don't want a manager, I don't want an office, I don't want to recruit anybody, I don't want to deal with other people other than my clients and my company. So I'm going to call Mutual of Omaha and sign a contract directly with them. And then I'm going to call another company that also participates in this American agency system and say, hey, do you participate in the system? Let me sign a contract directly with you. So now I work with Mutual of Omaha, Transamerica, and F&G. And guys, I'm just giving examples. I don't know if those companies participate in these systems, but as I'm going, right, we're going to just go with it. So now I can be a broker for all 3 of those companies, or I can just say, you know what, I just want to work with my company number 1 with Mutual of Omaha and continue with that one company. But this person is a 1099 agent. The companies are going to pay them with commission. And again, they set their schedule, they set their hours, they work from wherever they want. They are truly independent. They have no manager. They have nobody else they work with. If this person needs help, they would call the 800 number for their companies that they sell with, right? And they do need to be licensed with the state. So all 3 of these are agents. All 3 of them need to be licensed with the state. They're all 1099 contracted workers, which means all of them work off of commission. Some of them have a little bit more freedom than the rest. So for you and your path, whatever you want to do is fine, guys. They're all good. Just kind of think to yourself, what is it that you ultimately want? Do you want to build a group and an organization? That would be maybe your system number 2. Do you want something more traditional where you want that schedule, that routine, that reliability and whatnot? Maybe that would be a system number 1 for you. Or do you just want to be completely on your own and you're like, you know what? I've got this. I'm going to get trained by my company and just kind of sell with the 1 or 2 or whatever. And I want to work from home. So that would be your system number 3. All right, your independent agency system. So in all 3 of those, you do need your state license. You need to be an agent before you can sign up for any of those. 4 is different, managerial system, in that here you do not need your insurance license. Here, these are mostly your banks. So think of like your Wells Fargo, your Chase, whatever bank you want to think about. You go to the bank and you're going to do your bank transactions, but then you're like, hey, the bank also sells insurance. They sell car insurance, house insurance, whatever, right? So those individuals who work at the bank, your tellers and people who are not in the more specialized positions, they do not need to go get their insurance license. They are going to get certified through their employer. Let's say it's Wells Fargo. Wells Fargo is going to send them to a training, and they are going to get certified to talk about or to sell that car insurance policy program at Wells Fargo. And they can talk to the customer, they can set up the deal, they can do all of that stuff, but only there. So then that customer, that agent, or that employee quits, and they want to go across the street to the insurance company, and they're like, hey, I've been selling insurance at Wells Fargo for a while, let me sell with y'all. Or, they're going to say, yeah, we'll go ahead and work with you, but go get your license, because they're not an agent yet. So here you've got your salaried branch manager, and they are and they are going to, again, be the manager, help them, train them, and all of that. Here, they are a W-2 employee. They don't need to get their license because they are getting trained and certified through their company to sell those company-specific products, okay? And that is the 4 types of systems. Again, the majority of companies work with system 2 and 3. There is a small handful of companies that work still with system 1. And if they are doing system 1, they're not doing 2 or 3. Because remember, system 1, we're agents, we're more captive, they're more traditional. So they're either in 2 and 3 or they're in 1. And then if you've got a company that's with system 4, typically those are going to be your banks. So think of that branch manager, that bank branch, to help you make that connection. All right, guys, so let's talk about the next thing, agent authority. So a while ago, I mentioned this word right here, authorized agent. Let's talk about this. So when you decide what kind of a system you want to work with, what kind of a company you want to work with, you're going to get to the fun part once you pass your test, and you're going to sign up with the company, sign those contracts, and become an authorized agent. So you're already an agent once you get your license and the state approves you and gives it to you. Boom, you're an agent. However, once you sign a contract with the carrier, they're going to give you a writing number that makes you authorized. So now you're an authorized agent of, let's say, Mutual of Omaha, and you are now able to go out and create contracts for Mutual of Omaha. You have the power to bind that company to the actual contracts. And that is going to be our main expectation, right? To sell contracts for our carriers. So that right there, guys, our main expectation. Also, the law of agency, this is another vocabulary word that I want you to know about. Although, honestly, this doesn't come up as much on the test. So law of agency, I want you to know about it, but you don't have to focus on this as much. Law of agency basically states that once you sign a contract, once you commit yourself to a company, you are now looking out for the best interest of your company. You are not there to look out for the best interest of your customer. You're there to help your customer as much as you can. You want to help them get a good policy that'll be good for them. But if for whatever reason during your application process, during that first meeting, you feel like, hey, there's something shady here, this isn't going to be a good policy or a good customer for us, it is legally your responsibility to get up and say, hey, I'm so sorry, I cannot help you right now, but let me come back later or whatever. Especially if you're in that house, you just want to say whatever you need to say to get out, right? But you make it clear to the customer, I can't help you right now. Then if you feel you need to, based on whatever is happening, that you need to call the cops or report it to somebody, then you would go about doing those steps. But that is the law of agency, that if we see anything shady, if we feel for whatever reason during that first initial application that this person could be doing something illegal with the policy, could be trying to do fraud or embezzlement, or maybe the money they're going to use to pay for this might come from illegal sources, then we get up, we tell them, I'm sorry, but we cannot put our company in this situation. And then you leave. And if you feel you need to report that to any kind of authorities or police or your managers, then it would be our legal responsibility to do that as well. And guys, I've been in a situation where I called my manager. I don't know what she did, but I'm pretty sure I met a Black Widow sometime back. This lady I was about 21 at the time. I was brand new in insurance and everything. But I went to this lady's house and she had been telling me how she knew life insurance was super important. And her husbands had passed away, left her some money. She wanted a policy for her at that time fiance, but she didn't want him to know about it. She didn't want him to sign it or anything at all. She basically threw me out of the house because I was like, well, I can't really do anything because one, he's not here. He's going to need to sign the contracts and all of this and that. And then I was like, we can work on yours. And she threw me out of that house. And I left there and I called my manager. I was like, I'm pretty sure I just met a black widow. This man's going to die. And I don't know if she followed up or called the cops or not, but you'll meet interesting people and see interesting things. So if something like that ever happens and y'all feel like, hey, this is shady, this is weird, need to report it, feel free to do so because by law, by the law of agency, we have to do that. And all right, guys, so these are our 3 types of agent authority. This I do want you all to focus on. I do want you to learn and to know because this does tend to come up on the exam. So when you become an authorized agent and you get your writing numbers, you get 3 types of authority. All right. First one is expressed authority. I want you to do this motion, expressed in writing. This is literally the things that the company expects from us. It is explicitly expressed in writing. For example, sell policies. That is the main expectation, right? Sell policy, solicit business. That's my example here. Another one would be set up a bank account for specifically insurance premiums, insurance money. Can't put that money in my own personal bank account. That is called commingling. That is super illegal. So that's going to be explicitly expressed in my contract, right? So expressed authority, the do's and don'ts of my contract, of my obligation. Now, the next one is slightly trickier. Your implied authority. Implied are those actions that we have to do. It makes sense. It's common sense that we have to get them done in order to complete my expressed authority actions. So in order to solicit business, there's a few things I have to do before I'm able to get that contract signed and sit down with that customer. Number one, I have to get the customer name, right? So we'll start here. So I have to get the customer name. I have to get a lead. The company does not care. They don't care how I do this, but it's implied that I have to get a customer's lead or customer's name to sit down and sell my policy. So in order to get here, I need a number one, get a name. They don't care if it's a referral that my mom gave me. They don't care if I ran a Facebook ad. They don't care if I bought leads from them or from a third-party owner. The point is I got a name, somebody interested in life insurance. My second thing is I need to make contact. They don't care if I call the person and said, hey, I'm Deanna calling from Mutual of Omaha. And that's another thing too. It's not going to say in the contract that I can use the name of my insurance company, but wouldn't that be better than, hey, I'm the insurance lady? Then they know who it is, the company, all of that gives you some kind of authority, right? So anyways, they don't care if I call them. They don't care if I text them. They don't care if I reach out by email. They don't care how I made contact, but I made contact. The next step is I need to get to the appointment, right? They don't care if my mom drops me off. They don't care if I drove myself. They don't care if I Ubered. They don't care how I get there. The point is I got there, but it's implied that I need to get there. And then I sit down with the customer and I sell them the policy. They don't care if I do a paper app. They don't care if I do they don't care if I do that paper app or an online app. The point is I made an app, I made a contract, and I sold it, which was my expressed authority. So in order to get here, I needed to do step 1, 2, and 3. All these 3 steps, they don't care how I did it as long as I did it. And at the end of the day, paper app, online app, doesn't matter. I sold the policy, which is my goal, right? So all these 3 actions that I had to do that was implied, like it's not on the contract, make contact, do this, do that. That may be in a training, but we're talking about specifically the contract. These are my implied actions. So implied things I have to do to get here, my expressed action to get this done, but they're not going to tell me I have to do them. They're not going to tell me how to do them, right? So that is my implied action steps. So my next one is apparent authority. The word apparent sounds like appearance, and I want you to do this with me. So apparent appearance, it appears, it is apparent that you can sell me insurance, that you know about insurance because it's on your shirt. It says Mutual of Omaha. And if I see you in the gas station and your shirt says Mutual of Omaha, I'm going to think, you can help me with insurance. I am giving you that authority based on your appearance, right? So think about this. When we see somebody in the gas station or in grocery store and they're dressed up in scrubs, automatically, you've already thought about it. That's a nurse, that's a doctor, that's some kind of a medical professional. So that is the same idea. They're giving you that authority based on your appearance, based on the fact that the insurance logo is on your shirt. You gave them a business card. That logo's on the business card. It says Mutual of Omaha Insurance, your name, your picture, whatever. It looks legitimate. It looks professional. Then I'm giving you that authority that's not even real. It's literally just based on appearance. It is apparent. And that is your 3 types of agent authorities. So how this comes up on the test, they will literally give you a definition type of a question. So it could say a type of authority that is based on the appearance of an individual that is considered to be a not real type of authority, but is based on your appearance, is what type of authority? A, expressed, B, implied, C, apparent, or D, principal. Every single time, of course, that would be apparent. Another type of a question, a type of authority that is explicitly stated in the contract is what type of agent authority expressed. The other way that they like to flip this around, since it's 3, anytime you have 3 or more items on your exam, you want to think about what could they throw in there? What could they throw in there that's going to be a little bit different? That's going to be oh gosh, I'm blanked out, y'all. But anyways, which is not a type of agent authority. That is what they're going to say, which is not a type of agent authority. The one that they throw in there that they love to throw in there is going to be the word principal. Principal is in reference to the company itself, so company authority. But depending on how you're using the word principal in your insurance exam, it could also be talking about the money you initially invested into your policy, right? Or into your annuity. So if you invest money into a savings account, that is your principal. But they like to use the word principal and authority because they want us to think of like a high school principal, something like that. And it sounds like it could be real, but it's not. So these are your 3 types of authorities. So be aware of that question, be aware of that answer, because I've seen it come up on the exam a lot, y'all. Okay. And these are your pictures to help you remember what these are. So expressed authority, expressed in writing. Your hand motion is this, like you're writing with the pen. So you got a little quill, a little pen. And then your actions that they don't care how you do them, you just need to do them, and you need to do them again and again, right? So in order to do my expressed authority action, my sell my business, solicit my contracts, there's steps I need to do. I need to get there. I need to set the appointment. I need to contact, right? And again, they don't care how I do that. They don't care how I do any of those things, but I need to do them, and they're not going to tell me how, or they're not going to tell me that I need to begin with. So that is one step. And then your apparent authority, I have a little t-shirt there because, again, based on your appearance, based on the logo on your shirt, based on the logo on your business card, based on the way you look, right? So these are the ways that I want you to remember this type of authority. Okay, so let's talk about completing the application. right? So completing the application. The application in the majority of states has two parts, and that is how we're going to call it. So part one and part two. However, some states are going to say it has three parts, but let's talk about this. So regardless of what your state says or how they break it down, this is the breakdown. Part one, this is all of your superficial information. If I can type your name in to Google, find you on social media, find your name, your birthday, your sign, find your what you live, where you live, approximate, right? Hopefully, and your income level, again, approximate occupation, all of that. That is your part one bit of information. If I can find it like this, then that is part one. That's all of our superficial bits of information. Your name, your age, your sex, birthday, address, where you live, what you do, all of that, part one. Part two is going to be your medical information. I hope I can't find this on Google if I look for it, but all of your medical history and everything you're dealing with, if you're taking prescriptions or medicines or anything like that, your parents' medical background, all of that is part two. So part one, personal information, superficial, social media information. Part two, medical information, yours and your family's. That is how most states have the this part of the application broken down as two parts. And then we're going to add the agent report. The agent report is not officially part of the application. We do not consider this part of the application. So it seems like we're filling out the application and the agent report because we're going to talk about them separately, but they're not separate. They are one form. It is embedded. Your agent report is embedded throughout your application. So you are filling out one form, one long form, especially if you're doing this on paper. But throughout, there will be little blocks that will usually be grayed out or a different color that'll say something along the lines of agent report, agent's thoughts, agent's observations, agent's considerations. They're going to say something like that. It's different per company, but that whole section, regardless of what it's titled on the given application you may be looking at, that is called the agent report. It's not part of the actual and physical application, but we are encouraged to fill that out. What that's for, and this is a question on the test that does come up. What is it for? It is our direct line of communication with our unknown underwriter. So make sure y'all pay attention to this part right here. All right. Sorry, guys, again, my allergies and stuff. But anyways, make sure y'all pay attention to that. What is that underwriting? What is that agent report for? If I see, for example, and this always happens, the biggest lie, the most common lie we're going to always hear, I'm not a smoker. But if I'm in someone's house and I see a bunch of used ashtrays everywhere, obviously my customer probably smokes. So I'm going to write that in my agent report. Client states, possible client states, he does not smoke. However, many ashtrays were witnessed in the house. When asked about it, client said his brother smokes and his brother visits him often. 2 weeks later or a week later, my underwriter calls me and says, hey, your client smokes. The doctor told him he needs to stop. That comes up in the medical report anyway. So people lie to us. We write down what they said. We covered our butts by putting that information on our agent report. So it serves that purpose too, but the main thing that it's there for, to give our underwriter, our company, heads up if we see anything kind of like weird or something they need to look into. For example, another time I was sitting down with this lady. She was an older lady. She was super sweet and nice. She, however, told me she was not taking any kinds of medication, no prescriptions or anything. I'm literally sitting about 5 feet away from her house. So on that agent report, I put many medicine bottles, prescription bottles were observed on the kitchen table. Sure enough, they did the medical report, they did the underwriting, and they found out that she was taking about 12 prescriptions at that time. So most of those bottles were probably hers. Maybe the rest were somebody else's, or maybe she's got double. But that was just one thing that the agent report is for. It's there to protect us too, because if I hadn't put any notes on those situations, or if we don't put any notes and we do see something a little bit off, they're going to call us and they're going to be like, didn't you notice A or B or whatever? And if we say no, then I mean, we said no, right? But they could still take some kind of action or question us or whatever about it. And then we may end up being in some kind of trouble or whatnot, depending on the company, the situation, all of that. So writing our notes is important, is encouraged, and it is there for those two main reasons. One, to protect us so we cover our butts. Two, for us to give whatever bit of information we feel is important for the underwriter to know or maybe to look into. All right. So again, the agent report, some states, this is part 3. Most states, this is not part 3, but they're going to talk about the application and the agent report as if they're 2 separate forms. They're not. It is embedded inside of your part 1 and part 2, and it is all throughout. If you're looking at your an application on the computer, there will be a little square. It'll say agent report, agent observation. Again, however the company labels it, you click it, you get a little pop-up window, we write our note, it shrinks back down, and that's that. Okay, guys, so this is something I said earlier, but if you're ever asked on the exam, how do you meet with your client? Again, utopia, perfect world, test world is that perfect world. We always go to the customer. We're always sitting in their home face to face. We never answer that we're on the phone. We never answer we're on Zoom. Again, always in person, face to face with your customer. All right, so one question that tends to come up, who needs to sign the application? Who needs to sign the application? Always your applicant. And again, your applicant. If you're in the application stage, you do not have an insured yet, this person could get denied. Just keep that in mind. Do we already have an issued policy? If we do, then we have a customer, an insured, whatever you want to call them. But if we are in the application process, we have an applicant, we have a potential insured, a potential customer, but they're not legit yet. They haven't been approved yet. They could get denied, and then everything finishes right then and there, right? So just keep that in mind, because that is one thing they will try to trick us with. All right. So making changes to a paper application. What happens if we're working on a paper application and we need to make that change? We've got 2 options. The first one, we scratch it out lightly. We still need to be able to read whatever was written incorrectly. Then we write the correct information either above or below, wherever you have a chance, as close to the original information as possible. Your applicant initials it, not you, not the agent, but the applicant, and it just needs to be their initials. So that's option 1. I would say if you have enough space to make it legible right next to it, do option 1. If not, start over with the whole new application. That's option 2. And one time I did that, I made a mistake. I scratched it. Writing was super, super tiny and annoying. So I wrote alongside the border of the page. They sent it back to me, and I had to go back to the customer about a week and a half later and redo an entire new application. So word of caution if you're dealing with paper applications, but hopefully the majority of y'all will end up doing nothing but computer apps, because they are easier, they are faster, and easier to change as well. Why am I including this as far as making changes to paper applications? Because many agents and companies still do rely on paper applications, and it does come up on the exam. So just keep that in mind, guys. All right, so let's talk about this right here. When it comes to our application, when we are in that first meeting with the customer, always, whenever they apply for something, we have to give them a point of sale form. This is also called a disclosure of point of sale form. These are 2 very fancy ways of saying a receipt. So if your customer applied for something and we actually went through and we did a whole application, they need some kind of records for them to keep. And this can literally be anything. It can be a napkin if you're in a store or a restaurant or whatever. It can be a napkin. You put down what they applied for, you put the date, you both sign it. That's what makes it legit. And their records. You can print a paper. It can be a white sheet of paper. It can be anything you want it to be, but basically you are writing the date down that you met with them. What did they apply for? And you got to be specific. 30-year term policy, a 30-year decreasing term policy for 150,000, and he's going to pay 56.25 per month. He dates it and signs it, you date it and sign it, and it's officially your receipt, your point of sale form, your disclosure of point of sale form, and that's that, and that's perfect. And that is what we call a receipt. Again, two very fancy terms for your receipt for your customer. And we give them this every single time we do an application. Okay. The next one is kind of tricky, y'all. This one right here, there is definitely situations that this comes up in, and this could come up on your exam, guys, but the conditional receipt, this is a bit of a complicated situation, so I need y'all to follow along with me and make sure you pause this, look at this chart on your PDFs, and make sure you understand it, all right? So let's talk about the conditional receipt. What is a conditional receipt? I'm going to read the definition for you, then we'll talk about it. When a customer gets a medical exam during the application process, a conditional receipt will be required, stating that coverage begins the day of application or day of medical exam, whichever is later, if no health changes have occurred during the application process. And that if is highlighted in red and it is in bold because it could possibly just get canceled and be completely done over, all right? And right here, guys, you have the red version and the black version because there's two possible things that could happen and two different forms that we would need to collect depending on the given situation. So now when you go to meet a customer, your first application appointment, the first time you meet with them and you take their application, they have the option to pay then and there for their first premium, or they can wait for the company to give them a decision and they can decide to pay when we do the policy delivery appointment. So depending on what the customer chose to do is going to determine which forms you need to get and what needs to get signed. All right. So in this scenario, we are going to be doing the same thing for the first couple of times. So November 1st, you go and you meet your client, you fill out the application, you give them your disclosure of point of sale form. He applied for his policy. He's good. On this side over here, on the red side, the customer decides to pay on the day of the application. Okay. So here he already paid us. And on this side over here, he decided he's not going to pay until the company issues the policy, until policy delivery. So here the customer paid us, here the customer did not pay us. November 5th, the customer gets sick and they go to the emergency room while our underwriter is investigating and trying to figure out, do we want to give this person a policy? Is this person a good risk for us? All right. So then on November 9th, the company approves the applicant and issues the policy without knowledge of pending medical exams. So our paperwork says that as of November 1st, on the red side, the customer is covered because the customer already paid for the policy. We don't know that there's a medical issue or anything happened at this point. All right, this is where it breaks off. On the 9th, we also issued that policy, but we know that the policy isn't active yet because he hasn't paid us yet. It will be active later, but this is where it's going to break off. On the 10th, we, the agent, go to the customer's house. How are you? Whatever. The customer tells us, hey, I went to the emergency room a few days ago, but I'm feeling good, whatever. But now there's an issue. We didn't know that during the underwriting process, the customer got sick What do we do? That's always a question that comes up on the test. We, the agent, have no authority to tell the customer we need to cancel. We're not going to do this anymore. I think we need a pause. We have no authority to do any of that. What does the customer do, or what does the agent do? I'm sorry. We run the appointment as scheduled. We are here to do a policy delivery. We're going to look at the policy the company gave us. We're going to highlight all the forms and tell them this is your policy, this is what you paid, this is what you're expected to pay, and your coverage. So we do our appointment as scheduled, but now, depending on when and what the customer decided to do for payment, we have to give them a conditional receipt. Regardless, we give them that conditional receipt because he got sick. So now we're going to tell the customer, all right, so here's the conditional receipt. It says that if the condition exists, that you are healthy, great, we continue as is. So now your customer, even though he paid, is not officially covered yet. So here on the red side, we ask the customer to sign that conditional receipt. He's basically stating that he feels healthy. However, we know that there's medical exams we are waiting on, and he's not going to be covered as of the first of the month, even though we already have money. He's going to be covered as of the day of the results. So when the doctor says he's healthy, if the doctor says he's healthy like he was on November 1st, or he told us he was on November 1st, then things continue as is. The policy is in force, and he's going to be covered as of the day of their results. Okay. And the next payment he owes will be whenever their next payment would be, maybe the first of the month. So that would be the end of that. However, if the company or if the doctor says, hey, this person does have a health condition, maybe they have heart issues, we didn't take into effect the day of the application, now we're canceling the policy, he's getting his money back, we're starting over from scratch, taking into account the new health information. So that is what the conditional receipt says. If you're healthy and there's nothing wrong with you, when the doctor says you're healthy and there's nothing wrong with you, then the policy is in force. Everything continues just the same. You owe us your next premium on the first of the next month. But if the doctor says you're not healthy and you do have some kind of an issue, okay, the customer has heart attack. Okay, so then we're just going to cancel your policy and we're going to refund your money. And then we're going to start over with the new application, taking the heart condition into effect. That's what's going to happen. All right. So that conditional receipt, both situations, we have to give them that. So they have to meet the condition of being healthy, like they said they were on the 1st, on your application date. And we're not going to activate the policy until the doctor says you're healthy. Now, that is that situation where they paid the first day. Now let's go to the other side where they decided to pay the day of their policy delivery. So again, we show up on the 10th. We're excited. We're like, hey, here's your policy. They tell us they got sick and they're waiting for the doctor to give them news. Okay, so we're going to run the appointment like normal. Here's your policy. Here's what you're paying, whatever. We're going to get that conditional receipt signed just like we did in the other scenario, because we have to tell them, if you're healthy, great. Everything's going to continue as is. If you're not healthy, we're canceling this. We're going to give you your money back and we're starting over. But in this case, we haven't charged the customer yet. We're here to collect payment information. We're here to collect that premium. So in addition to the conditional receipt, we also need the statement of good health. The customer basically has to give the insurance company permission to make that charge and say, hey, I know I'm waiting on a doctor's notice that I'm healthy, but I feel healthy and I still want this policy, so here's my money. So the statement of good health, they're basically stating that they feel healthy and they still want to continue with that application. So if they did not pay the day of their application, we still don't have money. What should happen is this policy gets paused. However, of course, the insurance company wants that money, and we're going to assume that the customer is healthy. So now we're going to get both the conditional receipt and the statement of good health. so that we can charge the customer, even though we're waiting on the doctor's notice to say he's healthy. So we're getting permission from the customer to charge that money. And that is what your statement of good health is. All right. And now your policies will always come with the conditional receipt, will always come with the statement of good health. It's good practice to get them signed anyways. However, if this is not the case, we don't need to get them officially signed. So for your exams, I need you to know these scenarios and when we get these forms signed. The one that's the most important here is your conditional receipt. That is the one that tends to get asked about on your insurance exam. When do we get a customer to sign it? When they got sick during the underwriting process. That's basically it. So guys, make sure that you review this chart. Make sure that you review the conditional receipt and this whole concept in general, okay? Because this is an important concept. All right, now let's talk about the representations and the warranties. These are statements your customer is going to tell you when you're sitting down with them and you are getting their information from them. So when you sit down with them during your application, you're going to be asking them different things. What is your birthday? What is your name? What is your health like? If it can change, if it is a representation, okay, if it can change, it is a representation. So representations represent today, but not tomorrow. For example, today my address is here, but tomorrow I can live over there. Today I'm 36 years old. And in a year, when you ask me, I'm going to be 37. So your age changes, representation. Your address can change, representation. Your weight can change, representation, right? So if it changes, it is a representation of the day of the application, but it can change. Now, if it's a warranty, it's guaranteed to be true. That is the statement I want you to look at and to engrave in your mind, because that is the term they use on the exam. Guaranteed to be true is a warranty. I guarantee a warranty, right? Same thing, kind of like when you go into a store, buy an electronic, they're giving you a warranty, they're guaranteeing it's going to work for so long. This, I'm guaranteeing that this is the correct information forever. So my social security number is never going to change. It was the same when I was 5. It'll be the same when I'm 50 that it is today. My birth date is 12/4/87. That's always going to be the same, right? Although my age is a representation, that number is changing. My birthday is going to be the same day always. Where I was born, my medical history, all of those things are warranties. So if I tell you I got my tonsils taken out when I was 20, I'm not going to wake up suddenly and be like, oh, I didn't get them when I was 20. I got them when I was 12. No. So your medical history is a warranty as well. Things that will not change. And that right there, guys, pretty simple concept, pretty straightforward. So just kind of make sure that you understand the difference between that representation and the warranty. The representation, the terms they use on the test is going to be to the best of the client's ability. So when you go to them, you're like, well, how much do you weigh? Well, I went to the doctor a while back. They said I weigh 200 pounds, but maybe that was 3 months ago. So it could be a little bit different, could be a little bit less. And again, something that would change. All right, so let's talk about incomplete applications. What happens if the underwriter issues a policy with incompleted applications? Real world, they're going to send it back to us. Like 99.999% of the time, they're going to send it back to us. Best case scenario, what's going to happen? We are going to go to the customer's house. Remember, test world. Even if it's one question, we're going to go to their house. We're going to sit down with them, answer the question, send the application back to the customer. So that is what happens with incomplete applications. But let's say that your underwriter was tired, annoyed, angry, or about to quit, or maybe a combination of all of those emotions or things, and said, whatever, I'm done. Oh, this person didn't answer the question about the aviation, the flight planes, or didn't answer the question about heart conditions either. You know what? I don't care. I don't care about that. So we're going to issue the policy. And then we find out that my customer does have heart conditions. 3 months after we issued the policy, the company is like, hey, this customer has ongoing heart conditions. Okay, well, we issued the policy, we didn't get the question answered, we've waived the right to that information, so now we cannot use that information against the customer. We can't cancel their policy, we can't raise the premiums because they've got heart conditions, we can't change it. Let's say we found out that they had an active pilot's license, even though they're working as a librarian. Okay, so typically, if you have an active pilot's license, even if you're not using it or working as a pilot, automatically denied. You need to sign what they call the aviation waiver. We'll talk about that later, but basically, the aviation waiver, if somebody dies while they're piloting and they're on the clock, the family does not get that benefit. They're waiving their right to that payment. The company in this case is waiving their right to that information. If they issue policies without questions answered, they're waiving the right to that information. They cannot use that information against the customer. So if we find out our customer does have an active pilot's license, but I didn't get that question answered, the underwriter didn't care enough to get it answered and issued the policy, the company can now not cancel the policy, not ask the customer to sign the waiver, and not do anything in regards to that because of that policy. They gave up that right. So that is what happens if they issue policies with applications that are not fully answered or completed. Now let's talk about insurable interest. So insurable interest, sorry, I just snapped my back. But let's talk about insurable interest. Insurable interest, this right here has to exist in order for you to be able to sell a policy to somebody or another person. So if a relationship meets the insurable interest relationship, you can legally sell a policy to that person for another individual. So let's say that you have a mom who wanted to buy a policy for both of her kids. That's the mom. That would be relationship number one. You can sell it, no issues. Now let's fast forward. Those kids grow up. They're taking care of their mother. Now the oldest is, let's say, taking care of their mother. She can buy a policy for her mom. So parent to child, child to parent. We literally flip those relationships around. Both of those, it's legal for you to sell that policy. The next one that is legal and already a set relationship, a grandparent can buy policies for their grandchildren. And when it comes to kids, we can either buy them their own policy or we can add them to an adult's policy with a child term writer. If that is what they're wanting to do, we would make sure that those relationships are established and are legal and are correct the day of your application. So relationship 1 and 3, the parent, the grandparent, those relationships are already set. They're already there, right? The next one, legal guardianship. If somebody has legal guardianship or power of attorney over another individual and it is legal, they've got the paperwork, they've got everything they need, they can sign that person up for a life insurance policy. And as long as it is legitimate and legal, and again, this is always a question on the test, the day of the application, then you can sell that policy. Let's say that you have an uncle who has legal guardianship of their niece on Sunday. You meet, you see the paperwork, it's legal. You sell the uncle a policy for the niece, that you can do it. Monday, legal guardianship is revoked. Oh, well, he signed her up. He got the policy. He pays for it. If it gets issued, it's good. He keeps paying for it and it's active and it's legal. Okay. So as long as legal guardianship, power of attorney is active, it's legal the date of your application, you're good. It's not going to get revoked. It's not going to get voided. It's not going to get canceled in any way as long as they keep paying those premiums. So those are your main 4 relationships. Okay, guys, and I want you all to make a note of this because people will argue this with you all the time, and on the test, it does tend to come up. Spouses cannot buy policies for their spouse. So if you have a married couple, the husband cannot buy one for the wife cannot buy one for the husband, all right? It has to be, let's say if I have a husband, I'm buying my policy for myself and I'm allowing my husband, I'm writing him down as the, what's it called? As a co-owner. And then that person would also own my policy or 50% of my policy, but I'm selling it. They're selling it to me. They're selling his to him. All right. And that is how that works. Once upon a time, it was legal for spouses to buy policies on their spouse, but Black widow situations, like my possible back then, that lady that I told you all about, you never know when you're selling a policy to somebody who may be separated or maybe planning something like that. So it became illegal a while back. So on the exam, they will try to throw that in there. Just know that these are your 4 relationships that you can sell a policy to for another person. If it does not meet one of those 4 relationships, it is an illegal purchase, an illegal sale. Please don't do that. The next one, the insurance exam says that we bypass insurable interest laws, and that is how they word it. So please make sure you're taking a note of that. Make sure that you pay attention to that. Bypass insurable interest laws by going into business partnership with somebody else. So if me and let's say my best friend decide to become business partners together, once we have that paperwork and it's legal and set and all of that, I can buy a life insurance policy on her. She can buy a life insurance policy on me. And there you have it. This would be a loophole to have couples buy policies on each other, guys. If they go into business partnership, they start a business, they can now buy policies on each other. They've created insurable interest because if, let's say, me and my best friend go into business partnerships with each other, maybe we're a catering company. I'm going out there, I'm getting us clients, I'm doing marketing and stuff. She's in the kitchen cooking for them and the parties and whatever. If she doesn't show up to cook, I don't make money. If I don't show up to get the business and to get clients for us, she doesn't make money. So now our livelihood depends on each other, showing up, being healthy, and doing our jobs so that we can both have a good standard of living. Now we've created insurable interest with each other and we can buy those policies. So that is the train of thought with that. So again, these 5 relationships, we can sell policies to. If they're not one of these 5, we cannot. All right, so let's talk about underwriting and the sources of client information. And of course, the main sources of client information that we're going to send to our underwriter is our application. That is where it all starts. That is the beginning of the entire process. We meet with the client, possible client, potential client. We work on that application and send it to the company. Then our underwriter is going to receive that paperwork, and they are going to go through underwriting, which is the process of risk selection and classifying a risk. So remember, during this whole process, during this whole time, the client isn't our client yet. They're not an applicant. The underwriter is thinking about them as a risk, a possible risk for the insurance company. Is this a suitable risk or not? That's what they're trying to determine. And then they say, yes, this is, they want to find out what is a good price point to charge this person. We talked about it earlier. Somebody with, maybe we're expecting this person to live 40 years. We can charge them $200 a month. This person, second person, due to health concerns, due to other issues, this person might live 20 years. We're going to charge them $400 a month, right? Because we want to try to get money from these risks. So what are the 3 sources of client information? The first one is the application, I'm sorry. We fill this out, we send it to our company. The next thing is going to be that agent report. Remember, that agent report is not an official part of the application. So we've got our application and our agent report. They're separate. I don't know why I keep wanting to say applicant, y'all, but y'all know what I mean. My application, my agent report. And it is embedded together. It is not a separate form, but they're going to look at our notes and what we sent them in, and they're still taking that into consideration. They're still looking at that based on what we said, because remember, the expectation is we are in the customer's home with them, and we're looking at everything and we're talking to them and stuff like that. And then they are also going to do research on their end. They're going to go in and look at that inspection report. They are going to investigate everything about this customer, everything that they can possibly find to help them make as informed of a decision as they can possibly make. All right. So inspection report, we have nothing to do at this point. The underwriter is going to go look for their consumer reports. They could possibly interview their acquaintances, verify where they work at, shopping histories, credit scores, literally anything you can think about. Literally anything you can think about. So, I'm sorry, y'all. The MIB report, the Medical Information Bureau report, this report has anything and everything that somebody has done medically over the past couple of years in their lifetime. I believe it goes up to about 20 to 25 years. So this right here is more than enough information to help us make a decision about the customer based on their health. And then medical examinations and labs, tests for HIVs and whatnot, these are not asked for anymore. The threshold is $1 million. If somebody wants $1 million policy or more than that, they will be asked to go and get medical examinations and lab tests and